Okay, so you've done everything right, maxed out your 401k, stuffed your Roth to the ceiling, and you still have money left over, which is honestly a beautiful problem to have. But now someone in a nice suit is sliding a whole life insurance illustration across the table, and suddenly you're not sure if you're being offered a financial product or a timeshare. Let's set the stage fast, because this conversation matters more than most people realize. We're talking about a product that generates billions in commissions annually, gets misrepresented constantly, and yet, and here's where it gets interesting, actually does make sense for a very specific, very narrow slice of the population. The reason whole life keeps showing up at the party, even uninvited, is that it solves problems that pure market exposure simply cannot solve. Think of it less like an investment and more like a Swiss Army knife. Useful if you need every blade, but overkill if you just need to open a bottle. The first blade is the estate tax planning function, and this is where whole life genuinely earns its seat at the table. If your estate is projected to exceed the federal exemption, which as of recent years sits around $13 million per individual and $26 million for married couples, your heirs could face a 40% tax. Bill on every dollar above that threshold, and a well-structured irrevocable life insurance trust, or ILIT, can fund that liability with tax-free death benefit dollars. Here's the concrete scenario that actually justifies the purchase. Imagine you're a 60-year-old business owner with a $15 million estate, mostly illiquid real estate, a family business, farmland. And your heirs would need to sell assets fast just to pay the estate tax bill. A $1 million whole life policy held inside an ILIT with premiums funded by annual gift exclusions converts a potential forced liquidation nightmare into a clean, tax-free payout that covers the liability without selling grandpa's farm. Now let's talk cash value, because this is where the sales pitch gets romantic and reality gets a little more complicated. Whole life cash value grows at a guaranteed rate, typically somewhere between 2 and 4% depending on the carrier and the dividend performance, which sounds modest until you realize it's contractually guaranteed, non-correlated to the market, and accessible via policy loans without triggering a taxable event. That liquidity feature is actually underrated in specific contexts, particularly for high earners in high tax states who have already exhausted tax advantage space and are staring down a taxable brokerage account where every dividend and capital gain is a tax event. Compare that to a policy loan at effectively zero net cost, because the cash value continues to earn dividends even while borrowed against. And you can see why some tax-efficient planners find it attractive as a bond alternative rather than an equity alternative. But here's the irony, that almost nobody in the sales process volunteers if you compare whole life to a taxable diversified equity portfolio over 30 years. Whole life loses almost every time, and it's not close. The internal rate of return on most whole life policies doesn't break even until year 12 to 15, which means the first decade is basically a slow motion cost recovery exercise while your index fund friends are compounding quietly and laughing. Municipal bonds and CDs enter the picture as the honest competitors. And this is where you need to do the actual math for your bracket. If you're in the 37% federal bracket plus a state income tax, a muni bond yielding 3.5% tax-free might be more attractive than it looks, but it still offers no death benefit, no guaranteed cash value floor, and no estate planning architecture, which is precisely the gap whole life is designed to fill. The psychological trap most people fall into is treating whole life as either all good or all evil, when the real answer is purely situational. The question isn't, is whole life a good product? The question is, does my specific situation include an estate tax problem, a need for contractually guaranteed liquidity, a desire for non-correlated assets, and an insurability window that's closing as I age? Here's a misconception worth torching right now. Whole life is not an investment, so stop grading it like one. It is a risk management and wealth transfer tool that happens to accumulate cash value. And the moment you evaluate it on internal rate of return alone, you're using the wrong scorecard entirely. The practical lesson from every financial planner who has navigated this correctly is simple sequencing matters more than product selection. You exhaust tax advantage accounts first. You build your taxable diversified portfolio second. You address insurance needs as a separate conversation, and you only arrive at whole life when the specific levers it pulls, estate planning, guaranteed liquidity, and tax-free death benefit, are levers you actually need pulled. Discipline here means not buying the policy because the illustration looks impressive, and not rejecting it because a podcast told you it's a scam. It means sitting with a fee-only fiduciary, running the actual numbers against your estate projection, your tax bracket, your liquidity needs, and your time horizon, and letting the math make the decision unemotionally. Position size matters too. Nobody should be parking 80% of their surplus dollars in whole life premiums. A reasonable allocation, if justified, is typically a complement to your broader strategy, not the centerpiece. At the end of the day, whole life insurance is one of those rare financial instruments that is simultaneously oversold to people who don't need it and underutilized by the narrow group who genuinely do. And knowing which category you're in is the entire game. Rational preparation means you're comfortable with either outcome. You run the analysis, you buy the policy if it fits, you walk away if it doesn't, and your financial plan doesn't depend on the answer. And if you're ready to build a broader wealth strategy that goes beyond insurance products, whether that means real estate investing, renovation projects, or finding the right lending partner, we can help you get started. So check out our links in the description below.